Friends, in this podcast for iThought Advisor, I'm going to talk to you about the last financial year in perspective. Advisory practices have always focused on how to manage portfolios and volatility in ways which suit the investor risk profile. But an individual investor who does his own investing has a choice to do it whichever way he likes. But an advisor does not have that choice. He has to stick to the investor's risk profile, risk appetite, and advise completely in sync with what is suitable to the investor. I've seen a number of investors through the years who always played above their risk profile. In 2020, this number has reached alarming proportions. While as an advisor, one had to stick to a lot of prudent, conservative, and correct thinking, individual investors were playing cross-bat. The results are actually not too different if you look at it over a long-term perspective, because every cross-batted decision will not go to the boundary. Some will be great, some will be mediocre, some can fail. You could lose your wicket in some. For a long time last year, the runs were coming easy. So the focus was more on scoring. But as the environment changes, I believe the conditions are changing. You have to bat to the conditions. So even if you're an individual investor, I believe the time has come for you to be more circumspect and correct in your investment thinking. As an advisor, when I look back at the last financial year, I believe that being conservative was the only way to be, because investing in a manner which is outside the risk profile or appetite of the investor purely to get returns in difficult economic conditions is simply not the done thing. So when the conditions are uncertain, you need to wait, invest cautiously, choose safety, and protect the investor's interest. So portfolio advice or investment advice has to be cautious, conservative, and correct. In that sense, last year did not give advisors the opportunity to take the kind of risks which individual investors took. I see a lot of friends say that I bought this, it went up by so much, I did this, I did that. This is not new. I've been seeing this right from the time it came to market. But what I've also noticed is that as one gets this trading success, you tend to start making mistakes. Now is a time for investors to take their profits home, go back to conservative mode, stick to their risk profile and risk appetite, choose investments which are completely suitable to their financial goals and needs, and avoid getting caught in another round of market volatility. As an advisor, I believe that the next few years will be a good hunting ground for investors to choose which themes, which sectors, which funds, and which ETFs will benefit. As growth returns, it will still not translate into the kind of secular market growth that we saw in the last financial year, because flows will change, global investment trends will change, circumstances will change, macros will change. So you need to be in teams which can survive all these changes. Effectively, investment thinking must be more precise, more focused, more bottom up, and well researched. I don't think that what we saw in the last 1 year will happen in the near future. Understanding that and choosing the path of caution is what investors should do and advisors should stick to. For an advisor, it's continuing to do what he believes is right for the investor. For the investor, it's actually going towards what is right for him. So that's where we close this financial year, and that's where we should be right through the next financial year. Thank you for watching this video. Do share it with your friends who are keen investors. Thank you.